What's good, YouTube? My name is Chris. I'm a loan officer located in the state of Florida. If you're new to this channel, you're watching the Mortgage Millennial, where you'll find videos about everything you need to know mortgage and real estate related. If something like that interests you, go ahead and hit that like and subscribe button so we can get this channel to some more like-minded individuals like yourself. In today's video, we're going to discuss exactly what a mortgage is and the different types of mortgage that are out there. However, before we get into that, we have to really understand why mortgage is so important in America and how it affects you every day. First of all, according to Experian, about 44% of households in America currently have a mortgage. Now, that doesn't take into consideration those that paid off their mortgage. It's only considering those who currently owe money to the bank from their current home purchase. However, 44% is still a really large percentage of people when you consider how much the total debt may be. Mortgage inquiries rose about 50% since the start of the pandemic, which I found interesting because more people are applying for a mortgage before they even consider understanding exactly what a mortgage is. And I don't know, you tell me, if you were looking to borrow something that cost around $300,000, do you think maybe you should know a little more about it before you sign any documents? Well, in 2008, America learned this the hard way because it caused one of the biggest market crashes in U.S. history, because anybody and their mama could walk in and buy a home because neither consumer nor loan originator knew exactly what a mortgage was. America corrected this by making the barriers of entry to become a loan originator more strict and what it takes to qualify a lot more tougher. However, that still doesn't change the fact that many of the consumers know nothing about what a mortgage is. So basically all they did was protect America from another crash and leave the risk on you. And as long as you're able to qualify and go through the process of turning in documents, you'll be able to get a home. Now, there are good lenders out there that will take you step by step through the process and make sure when you get this mortgage, you understand exactly what you're getting and also how you can use this as a tool, and even follow up with you months after you get into the home to see if they can help you or give out any other financial tips. However, none of that stuff is required. As long as the lender gives you all the documents you need to sign and does their due diligence to make sure that you qualify, then they're good to go. Luckily, in this video, you have a better understanding of what a mortgage is, so by the time you're getting to the process of buying a home, you avoid making the wrong decisions and save money. Now, by definition, a mortgage is a legal agreement by which a bank or a creditor lends money at an interest for taking the title of a debtor's property. Or in other words, when you borrow money from a bank to buy a property and agree to pay it back at a certain amount of time with a fee, which is interest. That's it, right? Of course not. Banks wouldn't have the biggest corporate office in your city if it was that simple. Now, the way I like to explain it to clients is consider a mortgage as a tool. Now, what are tools used for? To put something together. And what exactly are we putting together? Now, you're probably thinking access to a home, but not necessarily. You don't need a mortgage to get access to a home. There's plenty of ways to get access to a home if you try hard enough. What you should be putting together is your financial plan with your mortgage. Now, follow along on this because this is where people tend to veer off. But the average homeowner is going to buy about 3 homes in their lifetime, whether they move to upsize, downsize, or relocate. It may take some time before you realize what home is going to be best fit for you. Now, the average cost of a home in America is about $300,000. If you do the math on that, that's an average of about $900,000 that you're going to spend on a home. You really want to be technical when you think about the inflation that's going to occur because, time's going to come by when you buy the home. You're going to be spending maybe around $1 million on real estate alone. However, what you spend on real estate has to be separated from what you spend on interest and also separated from the value of the home that you buy. Now, in a separate video, we'll talk about those other numbers, so make sure you subscribe so you don't miss that. But for now, let's stay on topic and talk more about this tool we call a mortgage. Now, mortgage payment is a total of 2 to 3 categories. Principal, which is the balance you owe on the home. Interest, which is the fee you pay for borrowing money, and in certain cases, mortgage insurance, which is basically a fee for being a risky borrower. When you also include taxes and insurance, this is what you're going to call your total mortgage payment. Now, when you're paying your mortgage, the first 5 years or so, you're going to be paying more money on interest rather than principal. Banks want their money first before you even get any type of ownership in the home. There are many types of mortgage products out there, but in this video, we'll go over the top 4. But before we do so, let's talk about what terms are. Terms is basically a term that means how long you're going to take to pay back the mortgage. The longer the term, the smaller your mortgage payment. The most common terms are 30-year mortgages and 15-year mortgages. I'm not going to go over which one you should choose because I believe that everyone is unique and we shouldn't go about it in a one-size-fit-all approach. But I will say there are a decent number of arguments for both sides, for and against 15-year and 30. Now, as far as the most common mortgage types, let's start off with FHA. An FHA loan is a loan that is funded by the government, which basically was made to make home ownership more accessible to lower income and lower credit home buyers. The way it does this is by making it easier for you to qualify by lowering the minimum credit score to as low as about 580 and lowering the down payments about 3.5% in most cases and increasing that maximum debt to income ratio. Now, this is great for those that are entering into home ownership. However, a lot of people skip over a few important details of this loan that do deserve attention. This mortgage requires mortgage insurance for the life of the loan. Mortgage insurance is basically a fee that you're being charged for being a risky borrower. A lot of people don't realize this, and they end up paying years of mortgage insurance that goes to nothing but the government pockets. The next loan we're going to talk about is a conventional loan. Conventional loans are funded by the private banks. Now, conventional loans were first only accessible for those with higher income, but the private banks had to compete with the FHA loans and all the other products out there, so they adjusted to make their mortgage program more accessible. Now the down payment is usually 5% for a standard home purchase and 3% actually for a first-time home buyer. With conventional loans, your credit can only go as low as about 620 in most cases. However, usually when your credit's that low, you're going to end up having to have a higher down payment, but this is going to vary based on the lender. Now, with conventional loans, your mortgage insurance is going to be removed once you have 20% equity in your home. And equity means how much you owe on a home compared to how much your home is worth. For example, if you owe about $80,000 on your home and your home is worth about $100,000, you'd have about 20% equity in your home, allowing you to remove the mortgage insurance. On top of that, the amount you pay in mortgage insurance is going to be based off your credit, meaning that the better your credit is, the lower your monthly mortgage insurance payment is going to be. The next type of mortgage is going to be a VA loan. The VA loan is meant for the Army veteran. As far as the VA loans, you can have a 0% down payment and you don't even have to have mortgage insurance. The only caveat I really can find to VA loans is paying that VA funding fee. And honestly, it's not as bad as paying mortgage insurance. But the VA loan does require at least a 640 credit score, which does limit a lot of people from actually qualifying. And this is most cases, obviously. The last loan I'm going to talk about is the USDA loan. It's honestly the only loan out there that I'm going to discuss that's going to be based off of your location. USDA loans are meant for those in rural areas, and it basically allows you to have a home with zero down and no mortgage insurance. So similar to the VA loan. Now, of course, there are many other loan programs out there that I ended up leaving out, like doctor loans, first responder loans, and so on and so forth. But the point I'm trying to make here is first figure out the loan program that works best for your unique situation. Study the program and figure out how you can use this program as a tool for your financial plan. And then you contact the lender or real estate agent and let them know that you're looking into getting this mortgage program. That's going to be the best way you can make sure you save the most money on closing costs, on interest, and just time as well. Now, if you watched all the way through, make sure you hit that like button. Lets me know I'm doing well. And while you're at it, go ahead and hit that subscribe button as well. That'll do it for today. I'll see you guys in the next video.